Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for July 14th of 2024. So we get into the data this week. We have kind of a discussion of inflation. We've got some data from the CPI report, Consumer Price Index, as well as producer prices. And we'll talk about that a little bit. We'll get into valuation within the equity markets and some other economic data. Quick programming note, I'll be out of town the next couple of weekends, so there will definitely not be a Charts of the Week next week, but hopefully that last week heading into the beginning of August, if I have time, I'll be able to put one together, but obviously continuing to watch the data nonetheless. But first of all, let's kind of jump into this and talk about the GDP estimate, because we are going to get this number very soon, at least the first reading of the second quarter GDP for the 3 months ended June 30th. You can see we've got 3 years of data kind of overlaid. These are essentially estimates. You look at 2023, which is in kind of that, purplish line. You can see those estimates went higher coming out of a very weak 22. And then we hit 2024, which is where we're at now. And so those estimates seem to be rising. And there is a little bit of discord. We'll see the Atlanta Fed's GDP now is showing a little bit of weakness, but the consensus feeling is that the economy is going to perhaps do a little bit better, although we see data points that would tend to suggest that things aren't going to grow as fast. And therein lies a little bit of a conundrum here. So, and then if you look at kind of the decidedly purple line there, it looks a little bit flatter. You can see that 2025 estimates are kind of in that 1.8 to 2% range. And so that's a little bit below what we're expecting this year, at least from these consensus estimates given to us by Bloomberg. You see that number is like close to about 2.4%. And then 2023, as we know, was closer to 2.5%. This is an interesting chart I came across from Guggenheim, great research team there. So this is an overlay of the Economic Surprise Index from Bloomberg, and that's in the dark line. And you can see where economic surprises have been negative. And we talked about this, and there are other surveys that track economic surprises like Citigroup. There's quite a few, and they're all showing the same thing, that economic surprises are becoming less frequent. But the research here at Guggenheim, and I tend to agree with it, focuses on the fact that the estimates for GDP in the consensus realm by analysts, et cetera, are so high that it's putting a lot of pressure on the data to meet the expectations that are out there. And so as things slow down a little bit, we expect the expectations maybe to come in a little bit. We already know that 2025, we just saw this, that the 2025 estimates are a little bit lower than the GDP that's been posted over the last 18 months. But right now, the issue is that you have more negative surprises that are developing because the estimates for GDP growth are so strong that it takes a pretty high number to beat those estimates. Here we have from the Federal Reserve Bank of Atlanta, their GDP Now estimate, which has actually been really, really good at forecasting data. And we just talked about the consensus estimate. And this is the reading from the Atlanta Fed, which has been very prescient over the last couple of years and kind of defining where GDP might wind up here. And so this is the second quarter GDP for 2024, and you can see here, as recently as the beginning of May, the estimates were about 3 to 3.25, and you can see that they've come down to about 1.5, and this is for second quarter GDP. And so you think about what are the inputs into that. Now we know that consumption is a very strong part of this. Investment, inventories within investment are pretty important. Government spending is also very important. We know that that's apt to slow down because the interest burden is rising. And then we have net trade, which has been kind of a fulcrum either way, as inventory has. But right now, the sum total of this by the measurement of the Atlanta Fed suggests that economic growth is going to be a little bit slower than what had been anticipated as recently as 2 months ago. We have this from Game of Trades. Really interesting. I think I just love parallels to history, even though, there are a lot of people out there that say, well, this time is different, and then it winds up being kind of very similar in terms of, how things react to economic variables. But here we have kind of an overlay of 1966 to 83, and we know what happened in the late 70s. The early 70s, we had the oil embargo, and so we had a lot of energy-induced inflation, but then we had missteps from the Federal Reserve insofar as monetary policy was concerned, which reignited and hypercharged inflation. And so this is an overlay of what happened back then to what's going on right now. And so we've got 2013 to present, and we know that inflation is coming down. But what's interesting is that during 1966 to 83, in 75, we did have inflation, but we got careless here and got easy again, and then we wound up having much more inflation. Now, it's not to say that that's going to happen now, but we're at a point now where inflation spiked, it's gone down. And, we're at this juncture here where the Fed is struggling to kind of come up with its game plan. And, a lot of us are looking for rate decreases this year. In fact, the current consensus is now for 2 based on the CPI report, which we're about to get into. But, the worry here is, and the worst thing that could happen, and this is what happened back then, was that you get a little bit careless and asleep at the switch. You start reducing rates while, before you really feel like you've got your handle on inflation, and then it just winds up reigniting. That's the worst case scenario. And markets were not very fun back in this time frame back in 1980 until Paul Volcker came into the Fed chair and really bumped up interest rates again to fight this spike in inflation. But that's not to say that this is going to happen. It's just that this historical backdrop is really helping to inform decision makers in Washington about when is the right time to reduce rates and by how much. Now we'll talk about the CPI, which definitely surprised on the downside. You can see the overall number. We were looking for a slight uptick in inflation. We wound up getting a slight downtick in inflation. You can see, the hyperinflation periods here following the shutdown globally due to COVID. And then you got the core CPI, which, has been trending higher, stripping out food and energy. And that was, in fact, positive, but wasn't nearly as much as was expected. And so, overall inflation came down. Of course, we had a big shift in the equity markets where we had small caps that just erupted in one day. And then we also saw a big move in bond yields as well. But, this is a pretty tectonic shift when you think about it, because we haven't had a drop since 22, and that was very minuscule. And so this coming off of a period of, decent inflation and a period where we had a little bit of acceleration, frankly, in inflation. This is a pretty tectonic number. And you look at the core number, you can see that that's been trending a lot higher than what we've seen here over the last couple of months. So we have core CPI kind of depicted in a little bit more of a linear fashion. So this is the year over year number. So we are still tracking above the Fed's 2% target, which is kind of what you see here as a line of best fit. But we are coming down, again, the pace of which is the subject of lots of speculation out there. But we're about 3.25, 3.25 here. And you can see the Fed's super core, reading here, and this is service prices. And so we know we've seen a lot of inflation in the service market, and actually goods inflation has given way to service inflation. We'll see that here in a second as well. But here is the super core reading in the service sector, and we see that that's coming down. In fact, is negative. And we'll see here in just a second too that the majority of the components now of what are included in the CPI calculation are in fact below that 2% level. But key read here is we've got a lot of these things that have been contributing to inflation are now taking away from inflation, not the least of which is lodging. We still have auto insurance, but we had airfare drops there, and you can see that overall the super core inflation is moving into negative territory. Here we have goods CPI, and we know that that's been largely negative for a period of time, with some exceptions. And again, this data can be a little bit noisy, but this goes back to 2016. And so really we haven't seen that. But now on the flip side of the coin, we've got core services, which we know was positive and has been positive for quite some time. But the service sector is driving overall inflation. And you can see that's been a lot higher. And so the fact that we're only up 0.1% coming off of 0.2% last month and much higher levels before, this is an encouraging sign. So, again, you want inflation to drop. It helps overall growth. And obviously, we've got an AI-infused productivity shift that is probably already underway and will really begin to manifest itself over the next several years when AI gets embedded into core business processes. But right now, deceleration in core services CPI is very helpful at a time where we're getting consistent negative readings out of good CPI. Here we have rent. We talk about rent a lot, and OER, as it's defined, the owner's equivalent rent, has been very sticky. We can kind of see that here, but we do see some recent deceleration now. It's been higher. It's come off this peak, and we've been very pleased at that, and we figure that this would be a trend of some sort. But then when that downtrend kind of attenuated, we got a little bit concerned because what we're seeing here in new tenant rent indexes is a clear deceleration. I mean, this is moving down, close to zero. And so we figured it was a matter of time before this empirical calculation of owner's equivalent rent was going to drop. In fact, it did. So it is still elevated at a little bit less than 0.3% here for the month. But what you see here is that it's falling in line with what we experienced during the pre-pandemic realm, as we see overall month-over-month rent of primary residents also drop to these levels as well. But you can see that those OER and rent of primary residents, basically these numbers are embedded in kind of the green and the maybe not the amber, but kind of the beige level here. But the observed rents, whether it's CoStar, whether it's the new tenant rent index, are clearly decelerating at a much faster pace than what's being captured in CPI. And that's what gives me a lot of comfort in thinking that CPI is going to drop, which eventually will manifest into rate decreases, but will also likely manifest into a lower overall economic growth rate for 2025, which I don't think anybody should be scared of. But I think it's natural when you have, a higher for longer, and you have an economy that seemed to, like over the last 18 months, be much stronger than anybody would have ever anticipated, that it's going to cyclically shift into a slower period of growth. So this is out of B of A, and I think it's really telling here. So, I mean, we already talked about inflation being driven by services, but here we have basically the majority of the 74 components of the CPI calculation that are actually below 2%. And you can see here this by breadth, that's already down below 50%, and then by weight as well, you see that downtrend. So you have most of these components that are actually most of these components that are already trending where we want them to be in terms of inflationary impacts. We have a core inflation tracker. So this is more of a kind of a look ahead here. We've got the FOMC 2% target. We've got core PCE, which, again, different definition. It is the Fed's preferred measure of inflation, And then that's overlaid here in the red with the Goldman Sachs core inflation tracker. Again, both of those moving lower. This is what we want to see, closer to the Fed's 2% target. I'm not of the opinion, there's nothing that I've seen, heard, or read that gives me the impression that we have to be at a consistent 2% inflation rate before the Fed changes rates. In fact, if that happens, then we're probably going to experience a deeper slowdown. But I think this gives the Fed a lot of comfort to it may be a little bit later this year, September-ish. Of course, there's the election. They don't want to necessarily get involved in influencing that as much. But, we'll just have to see. But I think this is giving more comfort to the Fed in that ultimate decision to reduce rates. So now we'll talk about PPI, which was ahead of expectations. So in the highlighted piece here, this is from the research note from First Trust. So PPI up 2.6 versus a year ago. We have seen some upticks in PPI, which clearly works at odds with what's going on in consumer inflation. But we do know that we've had some various input cost changes that are not being passed on to consumers, but yet margins for companies still remain relatively high. So we're in this delicate balance. And so I do think that margins are going to remain relatively high. Right now, the estimate is that this is not going to be an impact for earnings growth, but it clearly has an uptick component to it that we need to be cognizant of. PPI was up 0.2%, and we know that CPI was actually down 0.1. So this is, again, working at odds, nothing that we should be necessarily really concerned about. If you go back to before the pandemic, we're basically at those levels, and we had that major deceleration coming off that price spike when we had supply chain issues, et cetera here. So PPI, just to highlight the fact that we're not in lockstep between producer and consumer prices, but we're not anywhere near a panic stage. Here we have market pricing for the number of rate cuts from the Fed this year. And, of course, we spent much of the year kind of worried. Well, some people were, I wasn't, but, the fact the economy was too strong. Why would you cut rates here? Generally you cut rates when you see evidence of some slowing or moderation or attenuation in patterns. And we didn't see that. But now, with that CPI report, we did spike over 2 full cuts this year. And the question now really isn't as much if they're going to reduce rates. It's more of a question of when. Talk about employment for just a second. We've got hiring intentions that are clearly moving down. We have layoff announcements that really haven't spiked, but they're a little bit elevated off their base. But again, going back to 2001, you've got here on the right-hand scale, as a percent of the workforce, actually a very clear kind of deceleration if you put that line of best fit in there. But the more noisier component of this is the hiring intentions. And after the dislocation from the pandemic, we've clearly seen a plateau, an interim plateau, and we've been in decline ever since. So this is kind of a healthy slowing of the labor market, which we fully expected, which is natural, cyclical, and nothing that I should be worried about necessarily. So here's an expectation for unemployment, kind of continuing on that last slide. Again, this is data from Guggenheim and their estimates. And so they see consensus at 2024 unemployment rate moving down. So, we felt like, back in 22 that, we were going to have a slowdown and we were going to have a spike in unemployment. And those expectations have been tempered because of the strength of the economy overall, even though hiring intentions are lower. But you can see the actual unemployment rate has been fairly modest over that time. And it has picked up, if you look from the beginning of 2023, not appreciably, but we're still at overall unemployment levels that are very close to historical lows. But the good news here is that the expectations beginning to converge here with what we're seeing in reality. Talk about small businesses and what they're seeing. Clearly we've seen a bit of a divergence of sorts between what big companies think and what small companies think. A lot of other factors at bay, like small companies tend to have less in the way of liquidity, less opportunity to get liquidity. Bank lending to small businesses a little bit more persnickety than it is to large companies. And there's a whole host of reasons why small company optimism might be at odds a little bit with large company. And we've seen that. So in looking at the data, we've got here the overall optimism index, which has been fairly subdued relative to history. This goes back to 2016. And so we know what happened with that pandemic. And good news here is we see a little bit more optimism, but really kind of channel bound for the better part of the last 2 years. I mean, we see outlook for general business conditions continuing to perk up, although they do remain subdued. So we're still in negative territory. But we like these linear trends here in both these cases. But again, when we talk about employment, just like we saw in the last couple of slides with hiring intentions, they still remain subdued. This is the actual employment change, and then this is the number of job openings. And so we see companies kind of like girding for a little bit of a slowdown and trying to right size and optimize their workforce. We do see, temporary employment kind of slow down. We see, obviously job openings going down a little bit. So again, very natural when you have a slowing in the overall labor economy. That's precisely what we're seeing now. Quick comment on rent growth as we talk about rents and payrolls as being kind of the stickier components of inflation. But, we see the influence of rents, even though we just showed you a few slides ago that observed rents are close to zero in growth right now. But overall rent payment growth is higher than we see in payrolls. And we see a little bit of a moderation in payroll growth. Again, this is from B of A, but it likely to see rents kind of continue to trend down and payrolls be fairly subdued as part of this potential slowdown in economic growth for next year. We've got cash levels, which we've been kind of monitoring in a lot of different threads here. So this is interesting work by Morgan Stanley. So we can see that, we had a drawdown in cash levels, and those ironically are beginning to perk up a little bit. And they have broken this down into basically income cohorts. You can see the top 1% here, lots of cash, and then you've got the 80 to 99 percentile here, looking pretty, looking a little bit higher than what we've seen. And then you can see here time deposits by household, by income quintile. The top 20%, have a lot more cushion than the bottom, than the rest of the economy does. And then you can see cash to income ratios are back, really almost back to pre-COVID levels. And so we had a lot of liquidity injections here. And we do know that a lot of people at the upper income cohorts were saving that because they didn't need it for spending. We saw a lot of the lower income cohorts spend down. And so we see checkable deposits, currency and savings deposits as a percent of discretionary income move down a little bit lower. And we see overall assets, a lot of this has to do with home prices, and that continues to move higher. But, it kind of a natural trend and what we'd expect to see at this point of the economic cycle in terms of cash levels. So we'll move into credit a little bit. We've got the high yield implied default rate, and this is something that has really belied kind of expectations for quite some time, actually. We look here, this is 2022, and we had a little bit of elevation, and feeling that default rates were going to continue to move higher as we were going to slow down and have, maybe a recession, back in 22. That was the consensus. It never happened. In fact, default rates, and these are implied default rates, they actually dropped. And now we're essentially a full standard deviation below the median. So default rates are exceptionally low. Expectations are exceptionally low. And there's a feeling of complacency out there with regard to credit. And it's very interesting to see that, because I would have expected 2024 that those numbers would have been, closer to here than down here. Now, we just got through talking about implied credit default rates on high yield bonds, and high yield bonds typically represent less creditworthy borrowers, right? And so they typically pay higher rates than highly qualified borrowers do. But yeah, here we have a slide where it's clearly an evidence that we're seeing more bankruptcies out there. This is not getting a lot of press. But again, if you have a slowing economy, this is what you tend to see, and we're seeing kind of a bump in consumer discretionary bankruptcy filings, healthcare and industrials. Ironically, we do see infotech. But as we all know, information technology extends well beyond just the AI and the Mag 7 stocks, and less when you get down energy, utilities, et cetera. But you can see bankruptcy filings by month. 2023 was a little bit elevated, and we talked about this a little bit last year in real time as we saw some of these higher prints, and it went down for a little bit, but now we're at levels that exceed that here in 2024. So year to date, we've moved up a little bit, and so this is the rest of the year here. They got us to 635 notable bankruptcies, typically larger companies, but you can see that is much higher than previous years. So we'll have to continue to monitor that as part of this, analysis of kind of the moderation in the economic growth. So now we'll start talking about the stock market, and you can see here very clearly we got the CPI print, and we saw a bump in the number of and percentage of S&P 500 members that are above their 200-day moving average, and so that number is around 70%. Now, when we talk about the 50-day versus the 200-day, there's a little bit of a different story. We've got that those numbers are closer to here. But these are longer term moving averages, and so we do see a little bit more breadth in the market, which is healthy, which is good. It's what we want to see. And this is the S&P 600. So this is the small cap index here, and the percentage of those companies that are above the 200-day moving average really did spike when we got that lower CPI number this week. So here's a chart of value versus growth, and this goes back to the beginning of this century. And what is very apparent here is that for the lion's share of this period, value outperformed growth. Here's the global financial crisis, and neither did well, but clearly value has over an extended period outperformed growth up until recently. When we've seen the emergence of growth. And of course, now everyone feels like, okay, that's the new normal. But I can tell you, I've seen this rodeo before. And just when you think that you've established a new trend, I do think there is some merit to increasing value allocations relative to growth, because as we'll see in a second, valuations have gotten a little bit stretched in that regard. But then when you look at overall value, valuations, they're not nearly as stretched. So here are the PE ratios. Magnificent 7 continue to be very highly valued, and that's no surprise here. When you look at the equal weight, we're still about 17. This is the ACWI, so a little bit more of an international focus. So, these are a lot more attractively priced in terms of just PE, price to earnings ratios, than we see in those high flyers. And then you get down to emerging markets, small cap, Europe, and China. They're all kind of in a range, much more palatable to the average investor that's concerned with valuation. We've got a dot plot here. This is again from Guggenheim. This is talking about earnings growth, and not just valuations, but earnings growth. And so this is what's helping to propel the equity markets. And we see here very clearly that in 2024, as we look out into fourth quarter, even third quarter, we'll get those reports basically in kind of the second week of October for the 3 months ended September. But when you get into the fourth quarter, we're looking at 17% year over year. And you can see that, these represent the 2023 estimate changes. Of course, beginning of the year last year was a little bit more challenged. And then we saw something that was a little bit more normalized here. And so we've had good earnings growth year to date in 2024. Again, like I said, that's helped to propel overall stock prices. But we have a lot of optimism built into that in the second half, and so I want to be guarded a little bit and not getting too overly optimistic, particularly with this number here. So when we continue this conversation about earnings, we want to look at the actual historical levels of earnings, and so we saw the percentage terms in the prior slide, and here are the aggregate numbers for the S&P 500. So when we talk about, the estimate for 2024 is actually $243.74 for where the index is trading now, and then that's expected to bump up to 278.80. And you can see that there's a clear breaking out after several years of relatively modest growth in earnings, and so that's helping to drive earnings. And what we really want to see is an increasing level of participation from the rest of the market, which is honestly kind of lagging behind those magnificent sevens. When you look at equal weight performance year to date, it's relatively subdued compared with those high flyers, but we definitely want to see greater earnings participation by those companies. Here we have the S&P 500 earnings evolution, and this is kind of highlighting what I mentioned in that last slide. I mean, you've got high flyers that are driving the overall number, and so we've got July. We're looking at like 2.5% in terms of the evolution of observed earnings, but if you take the average stock, I mean, they're not doing nearly as well. And you've got half, when you look at, the half below and a half above, then that number looks even a little bit worse. So, we do have a concentration of earnings growth that's being driven by a relatively small subset of the overall index. Here's an earnings attribution, which just kind of highlights the point that I've been making, that a lot of this market continues to be driven by these high flyers. With the exception of Tesla here, we've had relatively strong earnings growth from all the mag stocks. Most notably is NVIDIA, which itself, has accounts for a little bit less than 5% of the first half attribution, and you can see the contribution of all of the stocks is only slightly greater than that. So clearly the mag stocks have had a pretty strong influence overall. Here we have a percentage of the index members that are outperforming the index, and so this is a really good measure of breadth put together for us by Cap IQ and First Trust here, and you can see that number has trended lower. And so what this means is basically you've got about 25% or a quarter of the stocks in the index that are actually outperforming the index. And so this is a measure of breadth that is clearly in decline. we had, not quite, 60% of the index was outperforming in 22. Of course, that was a negative year for the index. And so that was it was a pretty challenging environment. So all of the numbers, all of the observations above 50% are in blue here, and all the ones below it are in orange. But you can see clearly the 25%, that's still pretty limited breadth overall in the market. This is from Uri Timmer at Fidelity, who gets the award consistently for the busiest charts. But really just simply, it's kind of a breakout of what we see the overall index value at. And I love these because he shows basically a trend line, which is a kind of a technical analysis. This is the trend line from 2006 to 19. And so these dotted lines on either side represent one standard deviation to the mean, which you're going to see basically 67% of your observations between these two lines. And every once in a while, you get a little bit of a deviation from that, but generally it will follow along in this trend. Well, we've busted through that standard deviation again, but that's based on essentially you've got the cap weighted trailing price to earnings ratio, and that's a mouthful, but the cap weighted is essentially the published S&P 500 data. So you think about like the large cap firms like Apple and Microsoft, they have an outsized influence on the S&P 500 because they're mega caps. And but if you look at the equal weight trailing price to earnings ratio, you see that that's relatively subdued and kind of in line with, a long-term average here. And so, this is the argument that's made that equal weight is pretty attractive. Large cap stocks or mega cap stocks have gotten a little frothy, and you can see how, that has valuations, are going to correlate here with overall prices because you're driving higher valuation. This is multiple expansion here. And this is also multiple expansion here that is being driven in some measure by earnings growth, but obviously the expectation of continued outsized growth as we just saw. So here's a forward PE ratio, just as I mentioned here's kind of a working average forward PE ratio, an average of 17.4. And then you've got your standard deviations on either side of that. And so we're now more than one standard deviation above that mean at 22 times. And this is, again, the cap weighted S&P 500. So those mega caps are going to have an outsized influence. So the average stock, again, just to bring it home, is the average stock valuation is a lot lower. It's on the other side, if not right at this midline here of valuation. It's just the influence of those mega caps are causing these valuations to be outsized. And anything that gets above a standard deviation on either side is either kind of like overvalued or undervalued down here. And so we see a little bit of overvaluedness, which kind of leads me to think that with this economic backdrop evolving, as we've been discussing, that it might inspire a little bit more volatility in our markets, especially as we head towards presidential election. That as of this recording, yesterday we had the attempted assassination of former President Trump, and I think that just is going to lead to a little bit more volatility in our markets over the next several months, particularly over the next 30 days when we have two major political conventions. So we're still talking about the equity markets. I put two charts here. First one I'll describe as the put-call ratio, and that is going to be fairly opaque to most of you. But basically, this is an options ratio of how many outstanding put contracts to call options there are contracts on the market. And so when this ratio is in decline, that means that there's less put contract volume relative to call contract volume. And you buy a put when you're trying to protect against a fall. And so when the ratio of downside protection is lower, that just means that there's a greater degree of complacency in the market. So, and that's exactly what we've seen here basically since April. And so that's moved consistently lower, and we're at levels that we haven't seen since December of last year. So a lot of complacency in the market. But when we look at this chart, and we've got in this kind of this light purplish color here, this is reserve balances with the Federal Reserve. And we know that liquidity has been in a little bit of decline. Not only is the Fed kind of reducing liquidity in terms of quantitative tightening, but they're also, which in essence is reducing the size of their balance sheet, but they're also taking measures with interest rates to kind of reduce overall liquidity. So liquidity is dropping. And if you go back to 2019 here, you can see that there's a relationship between the liquidity in the market and stock prices, but that relationship has broken down considerably. And so, as I like to say, there's generally one of two things that can happen. Is you're going to have a mean reversion of some sort. Either this is going to go back up again, which is clearly not, or you're going to have some attenuation in the S&P 500. And I think that's the more likely scenario here. So we have one last chart for you today. This is something I thought was really interesting. Coming on the heels here in Texas of Hurricane Beryl. We're sitting here in central Texas, and we thought for several days that the storm was going to hit us directly, and oddly enough, it just decided to move east in a pretty rapid way. But this is to say that the expectation for the number of named hurricanes is expected to be much higher than it has been previously. We're looking for 17 to 25. And this is from Colorado State's forecasting office of NOAA. And the average number is 14. So if that happens, then we've seen clearly hotter temperatures over the last several years relative to the average June temperature over essentially about 30 years here. If that's the case, then we're going to have more storms. We're going to have more disruptions. When you think about the lateral impacts, like to the energy sector, when you're going to have shut-ins on offshore rigs, potentially if these storms hit in the Gulf, you're going to have more property casualty insurance inflation, and we've already seen a lot of that. And you just think about the various impacts to the economy from a situation like this. And of course, from there, trying to figure out what are the impacts to publicly traded markets and stocks in certain sectors, and some of the defensive ones that are likely to be consistent, more consistent, and then you've got the more discretionary areas that might be impacted by a shifting of expenditures to from truly discretionary things to things that people are going to have if they're displaced or disrupted by the storm here. Well, that's all we got this week. Hope you've enjoyed the chart pack. I hope you have a great week. Again, I will miss you next week and perhaps even the week after that, but we'll be back very, very soon with the next chart pack. Have a great week. Take care. Bye.